Hello everybody. In today's lesson I'm going to address the basic structure of the Elliott wave principle and why everyone and anyone who trades should learn the wave principle. This drawing here is basically the basic structure of Elliott wave. If we count the wave, we'll see 1, 2, 3, 4, 5, 6, 7 and 8. So the basic structure of Elliott wave contains 8 waves. 5 waves moving in one direction and 3 waves moving in the opposite direction. Now, here is the thing. The very first reason why Elliott wave is such an important aspect of technical analysis is because Elliott wave defines the trend in unambiguous ways. Every other way to define the trend involves things like higher highs, higher lows in an uptrend, and that is not enough because corrective structures also have higher highs and higher lows. So we in Elliott wave define the trend as per the 8-wave cycle. In other words, every time that we see 1, 2, 3, 4, 5, 6, 7, 8 waves developing in this manner, 5 waves in one direction, 3 waves in the opposite direction, then we define the trend in that direction. In this case, the trend will be up. So, what's the difference? Because we can say here's a high, here's a higher low, here's a higher high, here's a higher low, here's a higher high. So we could say, well, it's the same thing, but it isn't. Because the wave principle is the only system that actually gives you a set of rules and guidelines that specifically shows that if they are followed, then the trend is in that direction. If by any chance the rules are violated, then even though there are 5 waves in that direction, then it is not an uptrend or a downtrend if we were looking at the opposite drawing. So that is the very first reason why Elliott wave is so important. The main purpose of technical analysis is to identify the trend at an early stage and being able to join it. And that is what the Elliott wave principle allows us to do. And this type of structure, this 8-wave structure, appears in a minute chart, in a 5-minute chart, in a 60-minute chart, in an hourly chart, in a 4-hour chart, in a daily chart, in a weekly chart, in a yearly chart. It doesn't really matter. The structure is always the same. So I would say any system that allows us to identify the trend with the clarity that the Elliott wave does is a must to learn. And in the case of the Elliott wave principle, we identify the trend by identifying 5 waves moving in one direction, 3 waves in the opposite direction, and those 5 waves must follow a set of rules. The second reason why every trader must learn the Elliott wave principle is because the Elliott wave principle helps you identify counter-trend moves and via basically the 3-wave structures that occur after 5 waves. So you can see here there are 5 waves and then it's followed by 3 waves. Now the interesting thing is that each one of these legs, for instance this first leg, also has 5 waves. So whenever we identify this, we should see 3 waves coming down as well. And that means that every time we identify a 3-wave structure, we know that it is a correction and that the uptrend or that the trend is in the direction of those 5 waves that preceded them. So how do we do that? Well, in the wave principle, we do that by identifying 3 specific types of corrections. We don't actually see the corrections as, well, something that is noisy, that move sideways or something like that. No, we have very specific patterns, rules, and guidelines that identified each one of those corrections. And basically there are three: zigzags, triangles, and flat. And each one of those structures tell us a specific set of rules and guidelines where basically it tells us where they're going to finish, where are they starting, and what can we expect thereafter. So we have two main reasons so far: the identification of the trend and the identification of counter trend moves. Now there is a third reason that is contained again in this little drawing, and that is the resumption of the trend. The wave principle allows us to understand when the trend is going to resume. So basically, again, simply by identifying this 8-wave structure, 5 waves in one direction, 3 waves in the opposite direction, that we can already tell that the trend is about to resume, because remember, this identified the trend as up. So after the 3-wave correction, now we know that the trend should be resuming. And I'm going to give you clear examples of this with this chart. But basically now we have 3 reasons. We have the identification of the trend in an unambiguous way, the identification of counter-trend moves, the identification of trend resumption, and identifying the trend termination with the 5-wave structure, because we know that every time there are 5 waves in a structure, a move in the opposite direction must ensue. And by the way, you can see on this chart here, you can see the 5-wave move up from here, 1, 2, 3, 4, 5, and what followed? Well, a move in the opposite direction. And that is pretty much always the rule. 5 waves are typically followed by 3 waves in the opposite direction that identify the trend in that way. There is another reason why we must learn the wave principle, and that is because Elliott identified the use of Fibonacci. It was Ralph Elliott who pioneered the use of Fibonacci's. And so we can identify high probability objectives using Fibonacci relationships, because he noticed that each one of these legs, this one, this one, this one, they all relate to each other by a Fibonacci number. And this leg and this leg also relate to the preceding one by a Fibonacci number. So you can see that we have already identification of the trend, identification of counter-trend move, the resumption of the trend, identification of high probability objectives, and finally we can, or the Elliott wave principle allows us to know with the exactitude and the precision of 1 tick, 1 pip, where we are wrong in our interpretation. So what I'm going to do is give you an idea of how to do this in real time. And I'm going to use a real chart of what's happening right now at this moment when I'm recording this video. So I could show you an example of this. Typically, a person, any analyst without the knowledge of Elliott wave would think, well, here we have a higher low and a series of higher lows and higher highs here. There is no question about it. So now prices came down, but it didn't make a new low. So the sequence of higher lows and higher highs is still alive. Therefore, we should buy this market and expect prices to move above here. However, we as Elliottians don't see it exactly that way, because for us, the fact that something is moving with higher highs and higher lows, or lower lows and lower highs, doesn't necessarily mean that the trend is in that direction. Not necessarily. Remember, they must follow the rules. So what I'm going to do is to show you this structure here in a smaller time frame. Let's move, this is a 4-hour chart. I'm going to move to an hourly chart and show you in a smaller time frame the way that this move to the downside developed. And I'm going to label it for you so you can see. So it is so easy to label things in this way. Basically, I'm going to put a 1 here, it came down there, a 2, and now I'm going to put the 3 here, and I'm going to tell you why, the 4th here and the 5th down here. So basically there are clean 5 waves down. Why did I put the 3 here? Because typically one of the guidelines of the Elliott wave principle is that the 3rd wave is typically extended. And when it's extended, it means that it's longer than the other waves, so the wave 1 and the wave 5. And it must show in the same time frame the 5 subdivisions. And you can see here 1, 2, 3, 4, and 5. So wave 3 is by itself a clean 5-wave structure. And that leaves us with 5 waves to the downside. And what should we expect now? Well, obviously we should expect an A, B, and a C. Okay, we're going to use the same type of labels here, so we're not confused. So you see the numbers are outside parentheses, so the letters should be also outside parentheses. And so, okay, we got there the very first reason why we should learn the wave principle, because it identifies in unambiguous way the trend. And even though we saw in the larger time frame that there were higher highs and higher lows, and even though we saw that, we can see here that there are 5 waves moving down and 3 waves moving up, which means that this is the exact same structure that we have been discussing, but in the opposite direction. 1, 2, 3, 4, 5, A, B, C. The 8-wave structure that we discussed a few minutes ago. And so we had that. We have 5 waves here, and that means that trend is down. So in what direction should we trade? Obviously, we should trade in the direction of the trend. And so now we know that the trend is down. The second reason that we discussed was the wave principle helps us identify counter-trend move via the 3 different corrective structures that we mentioned are zigzagged, triangles, and flats. So in this particular case, we happen to have a zigzag. A zigzag is a structure that looks pretty much like a zigzag, right? So in this case, we can see the zigzag. And I told you that all these structures follow specific guideline and specific rules. Typically, wave C's in a zigzag travel approximately the same distance as wave A. So all we have to do is to measure wave A by using this Fibonacci tool, and we project it from wave B, and we see that wave C appears to be exactly already at the 100%, at the level of equality. So that means that C is probably in place. So that means that we already have a 5 waves down and we have a 3 wave up, meaning that perhaps we could consider a short position, not a long position. And this already puts us in a much better situation, because we know what to expect here. We also discuss, the other reason that we discuss is that Elliott signals the resumption of the trend. So when is the trend going to be resumed? Obviously when the ABC is complete. Now, when is the ABC complete? Well, we know that when we have 5 waves in one direction and 3 waves in the opposite direction, this opposite direction typically travels 50 to 62% of the previous decline in this case. So we use the Fibonacci tool again, and then we look for a Fibonacci level that could be probably the 50%, between the 50 and the 62%. Those are ideal levels to aim where to start putting our short positions there, or short orders there, because that would identify the trend resumption once that the ABC is complete. Okay, so there was another reason that we mentioned on why everybody should learn Elliott wave, and that is because it announces the termination of the trend via the 5-wave structure. When we have these 5 waves here, we have 1, 2, 3, 4, and 5. We know that this particular trend to the downside ended, and that was to be followed by a recovery that typically would be in 3 waves and would take the shape of a zigzag, of a triangle, or of a flat. There are only three structures there. Sometimes they could take the shape of a combination of those, and that's why we need to use the next aspect of the Elliott wave principle that allows us to know where that termination of the correction could be, and that is via Fibonacci relationships. So we know that Elliott wave provide with high probability objectives using Fibonacci, so we know already that there are several possibilities here, right? One of them will be the 4th of 1 lesser degree right here. That would be a good place for this rally here to find resistance and start coming down. But there are other possibilities. As I said, it is possible that this ABC here is the beginning of a correction, and what we encounter now is another correction to the upside to actually reach that ideal level of 50 to 62% that we discussed earlier. So for that, we use the Fibonacci tool to see where could that be, and you can see here is the 50%, here is the 62%. So within this level here, we want prices to go. Okay, likely this is the place where we would see the entire correction end, and that is because we're using the 5th advantage that we were discussing, which is high probability objectives. And finally, the last one is that it tells us within a pip or a tick where we're wrong. So let's say that we decide to go short in this market, in this area. It could be about 100.40. It could be, let's say, this is 100.50. Let's say that we go short in that area. Maybe we put half of our position at 100.25 and the other one at 100.50. Okay, let's say that we do it that way. Then where is our stop? Well, our stop is going to be where the entire structure is going to be invalidated. Invalidated because it violates rules and guidelines, which no other system in technical analysis gives us. And that will be where the decline started, where the 5-wave began. There is a rule that says that the correction cannot go beyond the origin of the 5 waves. So if the 5 waves started here, we have 1, 2, 3, 4, 5. The 5 waves started there. When we enter a position here, our stop is 1 pip above here, because prices could travel all the way there, but could not go 1 pip, because when it goes 1 pip, we know that this interpretation that we had here was incorrect. Now, when we have 5 waves so clearly identified like the ones we have in front of us, it is rare that we see the invalidation being affected. And that's why the Elliott, or trading with the Elliott wave principle, brings so much confidence. And that is the reason why. Notice that we said that here we expect a resistance around here, because wave C already accomplished 100% the distance traveled by wave A. So we know that around here we should start seeing some decline. That decline may completely take this low here and continue in a resumption of the downtrend. And we know that via Fibonacci projections that decline would typically take at least the same distance of this one. So it would travel the exact same distance that this one traveled as a very minimum expectation. So we would expect prices to go much lower. And that's the reason why trading with the wave principle provides you with so much confidence. It provides you with so much calmness when you trade. It provides you with so much certainty when you are able to count to 5 waves. Learn those rules and guidelines that basically rule the world of the 5 waves against the 3 waves. Learn how to identify 5 waves against 3 waves, and then you'll be in the right side of the market. Look at this very quick example right here. You can see from the top here how prices came down in 3 waves. Came down, up, down. You remember that structure? We spoke about it and made a small drawing a few minutes ago. That structure is what we call a zigzag. And what is a zigzag? We said a zigzag is a corrective structure. So if there is a correction moving to the downside, it means that the trend is to the upside. And that is exactly what happened here. The trend was up because the correction was down, and prices continue moving higher above the previous high. That is the beauty of the wave principle, and I hope that you find yourself the courage to learn it, because yes, it is true, the Elliott wave principle is not for everybody, but it should be a must for every trader. For everybody who wants to trade successfully should have the courage to learn every detail of the wave principle, every rule of the wave principle, every guideline of the wave principle, because the wave principle provides us a map that transforms an infinite number of possibilities into a handful of probabilities. Notice how the entire thing that we have here, notice that now we don't know if we don't use the wave principle, we say, well, probably this is going to continue moving higher because there was a series of higher highs and higher lows in the larger time frame, remember, and this was a higher low. So let's buy. Well, but with the wave principle, we don't have that. We can transform that number of possibilities into a very precise number of probabilities. What are those probabilities? Well, we said wave C already traveled the same distance as wave A. So it's possible that now from here it start moving down in a very corrective manner, leaving the trend still up for a short term to accomplish that 50 to 62%. And there is a possibility that also the trend continues down. But notice that we had 2 probabilities there. We transform all the, well, it could go sideways, it could go up, it could go down, it could do whatever. Now we only have 2 clear probabilities. Either a move down from here in a corrective structure that allows the entire correction to move a little bit higher, and from here we can confidently sell with stop here, or it's possible that the correction already ended because it's a clean, complete ABC. However, the guidelines tell us that likely it is not the case. Likely there is still a move to the upside, but we have to be aware that here is a probability to sell even for the short term, because you sell here at 100 more or less, and it's probably going to come down to 99.60 or something like that. So that would give you 50 pips of profit during that small correction. Not that that is the way that we would like to trade, but that tells you the probabilities. Probabilities are clear, using the wave principle instead of a bunch of possibilities, actually an ocean of infinite possibilities against a handful of probabilities.